Good afternoon, ladies and gentlemen. This is Robert Rayburn. It is May 1st of 2023. And I'm certainly glad that everyone could join us today. Hope that everyone had a great weekend and is having a great start to the week. We got a lot to talk about, whether we're talking about the U.S. debt ceiling or what is more than likely a banking failure here at, or not here, at First Republic Bank. So all of these things have broad implications as it relates to credit availability, as it relates to asset allocation, as it relates to how different asset prices move. So we want to go ahead and get started. So the title of this week's presentation is U.S. default ... possible. And there's a reason why, because when we look at the credit markets right now, they're signaling something that they have never signaled before, which is real concern that the U.S. could move past that debt ceiling deadline and not pay its debt that is due on that day. And that would be called what we call a soft default. So in other words, yes, the U.S. is going to pay it back, but it's going to be delayed by a few days. That doesn't make it that much better. We're going to talk about what that would mean and what that would signal and how we should try to prepare for that. So we're going to go through that, the three big things this week, why we don't own banks or technology stocks. We're very confident in those calls, and we continue to be. We've seen a huge narrowing of breadth across those sectors. Number two, are credit markets beginning to think about the unthinkable, which would be a potential for a U.S. debt default in a soft way. So in other words, a delay by a day or two, moving past that deadline, or what the implications of a debt deal would be. So in other words, they come to a deal, they being Congress, what would that mean for the economy? What would that mean for the currency, for the US dollar, et cetera? Number three, assets that benefit from the projected policy environment that would result from eventually passing that debt ceiling deal. So when we look at right now the technology sector, I got to say, this is one of the charts that probably concerns us the most. So when we look at the percentage of stocks trading above the 200-day moving average, so in other words, how many stocks are participating in the rally, despite the fact that we've seen the NASDAQ rise since, call it mid-February, or really March, when we had that sell-off due to the banks, NASDAQ has rallied, but look what's happened underneath the surface. More and more stocks are breaking down. More and more stocks are selling off. So we've gone from 85% of stocks trading above that 200-day moving average all the way down to 46%. So that means that what's holding up the index are just those mega caps like NVIDIA or Tesla or Microsoft and Apple. And that's not a condition you want to see, because at some point, as the majority of troops fall by the wayside, at some point the generals get shot. And so we want to be really careful about chasing hyper-concentrated sectors where they're only being held up by a few stocks. This is what we call narrowing breadth. It's not a high-quality technical condition in the overall market. Now, we didn't make a slide for banks, but banks are acting much the same way, with the only exception they didn't really bounce. So we had JP Morgan, Bank of America had solid quarters on that Friday. JP Morgan ripped something like 8% on the day. We weren't going to chase that rally. In fact, what we've seen is even those stocks within the banking sector have come in quite a bit and given back some of those post-earning gains. And we've seen with the banking sector as a whole, whether it's the regional banks or the small banks, they're trading near 52-week lows. And it's likely going to get worse when we see what's happened here with First Republic over the weekend. Now, we're recording this on the Friday, but it's likely, based on headlines here after the bell, that bank is going to go into receivership. And I think that's going to benefit some of the asset allocation decisions that we've made in the portfolio. We'll go through that in a bit. To understand what we are going to go through this week, though, we have to understand what a credit default swap is. So a credit default swap is basically an insurance policy for bond investors. The market as a whole uses credit default swaps to gauge corporate health. So in other words, if corporate health is deteriorating, those life premiums that are charged to the policy owner start to rise, right? So a good way to think about this is If you have someone who's 40 years old and they're paying $1,000 a year in life insurance and you don't know anything else about them, and they decide, you know what, I'm going to defer that decision on the life insurance. They come back a year later and the health insurance company says, well, now your premium is $4,000. It's probably fair to say that their health has deteriorated quite a bit over the course of the year. Credit default swaps act in the same way. If those premiums are rising, in other words, you see the chart of a credit default swap and it's moving up, it means that those premiums to gain access to insurance on the bonds, that means that the corporate health is being viewed to have deteriorated. So why are these contracts important? Institutional investors use CDS or credit default swaps to make bets on the health of a corporate entity, right? So if they think JP Morgan's health has deteriorated, they're going to buy credit default swaps to make a bet on that. Or if they have the bonds and they want to insure against losses on those bonds, they will buy CDS contracts as a hedge. Okay, most important chart on the market here today. So when we look at these US credit default swaps, this is, if you remember way back in 2011, feels like yesterday, we had the US debt got downgraded. And that was after we had this rancorous debt ceiling debate in Congress. They passed the debt ceiling very last second, right before midnight, and the US got downgraded. This was the credit default swap at the time it spiked. It's very unusual for US sovereign credit default swap to be anywhere close to 100 basis points. It got to about 85 or so, and then went right back down. And then there was another debt ceiling debate, and you had the same thing. But then largely speaking, for the next decade, it was basically a do-nothing instrument. Then over the last couple of months, this has happened. We're all the way at 176 basis points. Remember, when the US debt got downgraded, it was around 85. It's now at 176, and we're not even close to midnight as it relates to the debt ceiling. Why is this happening right now? We don't know, but we do know it's not a good symptom. And so we want to pay attention to that. It's very, very unusual. And the other reason why we want to pay attention to it is the more noise that this gets, the more it's a wake-up call to international investors, right? We know that Uncle Sam is in debt to the tune of $31 trillion. Here's the point, though. Half of that debt is slated to mature in the next 3 years. So in other words, the US has to refinance half of the $31 trillion that currently has a weighted average coupon of 1.9%. If they refinance, if the country refinance all that debt today, we refinance at 3.75%. That doesn't sound like a lot, but on $31 trillion, it's a lot. The annual interest costs on that 50% of debt would balloon from $589 billion to $1.16 trillion. And remember, that's only on the 50%. That's not on the other 50%. And that's assuming interest rates stay at 3.75%. So when that fiscal house is not in order, this debt ceiling debate can open up a Pandora's box of unneeded attention, right? So it's, all the stuff is happening and there's no noise, and so no one's really paying attention to it. We'll just buy US debt because it's US debt. They always pay it back. But when something like this happens, it opens the eyes, it creates noise. And then people are like, whoa, and they start to look at these numbers. And that's the problem. And that's where we think a lot of this stress is coming from right now. So there's these three key questions, in our opinion, that we think need to be asked and answered. What are the policy options to tackle high levels of sovereign debt? How does this impact monetary policy? And number three, what is the potential impact of policy on asset prices? So first, our view on how governments tackle debt is usually it's one of four choices. One is you default on your debt. That's a very, very bad option, and we don't believe that's one the US is going to take. Number two, this is probably another one the US won't take, is find another land to conquer in order to expand your tax base. That's what the Romans did. Romans are famous for that. They needed more tax revenue, take over another country, expand your empire, and increase your tax revenue. Number three, probably even more unlikely than the first two, is austerity or entitlement reform. reforming Social Security, reforming defense, reforming whole sorts of really popular entitlements. That actually might, in some ways, be even more unpopular because it might mean certain politicians lose elections. So that is probably extremely unlikely as well. That leaves you with the policy option number 4, which is usually the least painful, and that is debasing your currency and inflating away the debt. Making that US dollar cheaper, having inflation go up, and inflating the real value of your debt. And we think that's probably the most likely scenario. And that impacts monetary policy as well and everything that's going on there. It makes it so that you have when you have a volatile fiscal environment, it's harder to hike rates if you're the Federal Reserve. And so as growth slows, and it has been slowing this year, and these banking issues persist, First Republic, Silicon Valley Bank Corp, et cetera, bond investors are beginning to price in the end of rate hikes. So for the month of May, there's about an 88% chance that we'll get a 25 basis point rate hike. But notice what happens in June, that falls to 23%. So 23% chance of a rate hike. And guess what happens the rest of the year? The market's pricing in rate cuts. Again, this has implications as it relates to asset prices. We want to know what is going to do well in an environment where the US currency is potentially getting debased, in other words, devalued, and we're having lower interest rates. So what assets can benefit from a weaker US dollar and lower interest rates or a more dovish Federal Reserve? That's where gold comes in. We talked about gold last week, but also commodities in general. We don't think this is going to be like monetary policy from 2020 where they're printing money and everyone's buying profitless tech. This is a different type of environment. I think many investors will want to purchase gold as a hedge against the value of the US dollar. This is what happened in 2000 to 2009. And we know that the dollar is incredibly important to the value of gold. The last time we had a major gold bull market, this was the US dollar. It went down almost every single year for a decade. We think we're at the precipice of a similar downward move, perhaps more intense than that. So what's the bottom line as we go into the month of May? The US debt ceiling is potentially a little bit more serious than most are pricing in. I want to be clear, still think that the debt ceiling will pass, but we need to pay attention to the implications of the debt ceiling passing. What are going to be the policies that are approved as a result of that? Bottom line is we think gold is the answer. We think credit markets are pricing in an unusually high risk of default, but also an unusual environment as it relates to fiscal policy in the US dollar. Number 2, as we talked about before, there's no real attractive policy options. Weakening the US dollar may be the least painful option. And what benefits from that? We think gold and commodities in particular. So that's what we got for you this week. If you have any questions or concerns, please feel free to give your advisor a call. You could also reach out to our office at 888-543-3776. Other than that, have a great week, and we'll talk to you soon.